Hey guys, it's Chad Larson, portfolio manager with MLD Wealth. I'm here today joined by Dennis Mitchell, CEO and CIO of Starlight Investments. Dennis has been a colleague in a secondary and tertiary capacity for the bulk of my career, and we've had money invested with him for years. I just wanted to touch base with Dennis today and try to host a Zoom call where you can see us on camera and maybe make sure that I am working, which I am. But I wanted Dennis to I've sat through many calls with various managers and Dennis in particular through this. And I wanted to spend just a few minutes in being able to give back to you guys so that you can understand, what their platform is, what real assets are. Dennis and his group manage two sleeves of capital significantly for our clients, both in real estate and real assets. And I'll be following up this call later in the week with Varun, who runs the infrastructure sleeve of their business. But Dennis, thank you for being here today. And perhaps maybe we'll kick it off, with just, what are real assets and why are they important into a portfolio?
Sure. So let me start by thanking you, Chad, for this opportunity and for the partnership that we've had over the years. Real assets are essentially they're large assets that provide essential services that allow the global economy to function. And that's a mouthful. When it comes to Starlight, real assets fall into those two general buckets, real estate and infrastructure. When you think about real estate basically, whether it's apartments, retail, distribution, office, data centers, cell towers, they provide a lot of essential services that allow various businesses or consumers to get what they need, get to where they need to go. Infrastructure is a lot of augmenting what commercial real estate provides. So it's the power, it's the transportation, the communications, the waste removal. So it's hard to actually think of a form of economic activity that doesn't take place within some form of commercial real estate that isn't supported by multiple forms of infrastructure. So I noticed, Chad, you're in the office. Obviously, that's a piece of commercial real estate. You've obviously got a high-speed internet connection, electricity, hot water. So you can see how economic activity takes place within commercial real estate, and it's supplemented by multiple forms of infrastructure. And the great thing about real assets is they kind of provide all of the things that you're looking for in one investment. There's the income component, there's the uncorrelated returns, the long-term growth. And I think that's one of the reasons why pension plans and endowments have really allocated a lot of capital into real assets, not just this year, but going back over decades. You've seen their allocations increase to the point where you've got about 25% of their portfolios in real assets, but their target longer term is closer to 60%. And if you look at some of the endowment funds in the US, they're already at 60% real assets.
Okay, great. I think that's a great understanding, and it's traditionally and typically been an asset class that's under-owned by retail investors. Can you explain some of the shifts that we've seen with the creation, both product and the investable landscape through funds, ETFs, and even direct drive into securities, and how do you bridge those opportunities between public and private securities?
Sure. So when I started at a previous firm, I surveyed the landscape for real assets mandates. And what I discovered was that retail investors in Canada were hugely underserved when it came to product breadth and depth in the real asset space. Less than 3% of the dedicated capital in Canadian mutual funds and ETFs is in dedicated real estate and or infrastructure funds. So that's a huge underweight. And you can argue whether it's chicken or egg, if there's a dearth of product and so there's a dearth of allocation or vice versa. But at the end of the day, Canadian investors are underallocated to real assets. And so at Starlight Capital, what we've tried to do is we've tried to create a risk-return spectrum for Canadian retail investors that will allow them to invest in real assets, both publicly traded and private. And we've given it to them in different slices, if you will. So our funds and our ETFs are able to be 10% private. We launched a structured product that is up to 40% private investments. And we're rolling out new solutions that will be up to 80% private assets in the real asset space. So we really do want to be that premier partner for real assets for Canadian retail investors.
Sure. Getting into that a little bit, I'll circulate a lot of your bio and your history, which is very impressive along with this as our clients are able to see it. But I'd like to understand, how have real assets performed through this current market environment? And, I caution to spend a lot of time with this because we're investing over a long period of horizon, and in the annualization of any short period of time, creates an appearance of larger volatility. But here we are, and it's fresh in everyone's mind. So how have real assets generally performed through this COVID-19 crisis?
Sure. So what we initially saw when markets started to get weak in sort of the middle of February is we saw real assets outperform. And that's what we expected. They have contractual cash flows and revenues. And so there's a lot of transparency into how these firms generate long-term total returns. Towards the latter part of March, what we saw is real assets starting to sell off in tandem with the market. And this really surprised us because we certainly weren't anticipating this based on what we saw in previous market sell-offs. And subsequently, what we discovered was that there was an unwind of a structured product. And so, a redemption that had to be met by the end of the day, regardless of pricing. And that created a wave of indiscriminate selling in Canadian real assets in particular. And so at the end of the day, what you found was that real assets were deeply discounted. Since that day, we've seen real assets outperform, not just in Canada, but across North America and into some of the European markets. And that outperformance has been a function of looking at the deep discounts that these names trade at, the transparency and visibility of their cash flows and the growth in those cash flows, and then the outlook for growth and the resiliency of the demand that the services that these entities provide, whether it's residential real estate or whether it's high-speed internet access or waste collection. The services these firms provide are essential. They're resilient through economic downturns, and that's what sparked the outperformance since the market bottom that we put in recently.
Great. So that in some more layman terms, there was really a lot of a forced liquidity. Anything with a bid was being hit by forced sellers, leverage unwinding. How have you found some of the breadth? Like, I think, and then maybe this was a little bit off topic where we were going to go. Now it seems everyone has got a little bit of FOMO and is wondering if they missed the bottom dip. Are we going to retest? But in that, do you still believe that through the other side of this, that there still presents an incredible opportunity, even in a reversion to mean?
I do. And the reason I believe that is because real assets, when I started off with the definition, I said large assets that provide essential services. So we can look at these assets, we can look at their cash flow collection. Like, for instance, in the real estate space, there's been a lot of news recently about the amount of rent that's collected. Well, real estate REITs are able to report that on a monthly basis. So we know with a great deal of certainty that residential rent collections for the month of April came in at 90% plus, which is bang on for what they were in March and a year ago. Now you contrast that with, there are wonderful businesses out there like Starbucks and Nike, but they're not able to provide you on a monthly basis with how much coffee they've sold or how many shoes they've sold. And their projections going forward won't have the same accuracy or robustness as a REIT that's got a contract for a rental income out of a space it's leased, or an independent power producer that's providing electricity to the state of New York. So these businesses we see have significant upside because they're still trading at discounts to their long-term multiples. Their cash flow generation hasn't been impacted or impaired by the current environment. And in some cases, whether it be real estate or infrastructure, we're seeing cash flow actually accelerate during this time period because the services they provide are in greater demand. So we do see these names trading at a discount to their long-term values, despite the fact that those values haven't really declined much. And so we like the current setup and entry point.
How does this compare to, I'll preface it with partially some of my opinions. How does this compare to previous downturns? We're now comparing this to the Great Depression. We broke through the 1987. There's been these historic moments, a career's worth of volatility in the better span of a quarter. So as you can see, I have less hair every day, and that's just that's being accelerated during this. But as we all look to overlay charts, this and that, when I go back to the last time we went through this with the great financial crisis, albeit none of us could really, even having a background academically and in a career, could really quantify and understand the depth and the complexity to some of these toxic assets that were problematic on the banks. And it was very easy to blame Wall Street that they got greedy. The government stepped in, albeit Main Street was impacted, and we went through this period. But I find this period even more interesting. Call it as I have a joint degree in psychology and in economics. Is the social impact of this is it's you're at home and I'm alone. where people aren't getting together and making that plan and that plot for the next recovery in a cycle. How is this compared, not so much from an economic standpoint, but how your group is viewing how we transition out of this? Is this dependent on having clear and concrete view as to when we can pull start this economy, and will it sputter, and how does that work?
Yeah. So I think the recovery this time is going to be in stages, right? So if you're comparing things to 2008, 2009, the biggest differentiator is that we don't have a health crisis in 2008, 2009, whereas we do now. So the recovery in 08 and 09 was really about financial system repair. Once that had been established, you could see your path clear to recovery in economic assets. This time around, because you have the healthcare issue to deal with, I think the recovery will come in stages. And when you look at various industries, you can see that people's comfort level with re-engaging in those industries will differ. And I'll give you several examples. When it comes to toll roads, we don't have any exposure to that sector right now because, of course, no one's commuting to work anymore, with the exception of yourself, Chad. And so, volumes on toll roads are down dramatically. Now, when we come out of this, you can see people being comfortable getting in their car and driving to work by themselves. So we would expect that to be a sector that will recover very quickly. But then as you start looking at other sectors, like say movie theaters, gyms, restaurants, you can easily see those institutions opening up immediately, but limiting the number of people who can come, right? Maybe there are temperature checks like they're conducting in China and South Korea right now to allow you to come in, maximum guests in one party, and so forth. And you start looking at other industries like airlines. I have a hard time seeing people, clamoring to get into an aluminum tube and fly for 6 hours to Europe with a bunch of strangers. And so we can see the uptake there taking longer. And then finally, cruise ships. I think there is a big swath of the global population that will never set foot on a cruise ship ever again, no matter how cheap the cruise becomes.
Maybe they can store some of the oil that we're going to need places for.
You know what? That industry just added a ton of capacity. I can easily see them turning some of the older boats over to Doctors Without Borders, for instance, and donating them to a humanitarian cause because there's just too much capacity. But you can see how the economy is going to get restarted in sort of stages. And it'll take a while for us to get back to sort of the robustness in terms of interactions, personal interactions for sure, that we enjoyed prior to the virus. But at the end of the day, we are going to come back from this. And there are a lot of industries that are going to innovate out of this, that are going to create new jobs that will see economic growth increase. I talked to a sole proprietor just yesterday, and he ran a bowling alley. And we were talking about some of the innovations he's going to have to come up with. How many people are going to walk into a bowling alley and want to borrow or rent shoes that have been worn by 30 or 40 other people just this week? Mm-hmm. He said there's a guy already come to see him about slip-ons for the bottom of normal everyday shoes. Right. Every bowling alley is going to implement technology like that, and that will be a new industry that comes about. And it's not something you or I, Chad, would think about, but somebody who runs a bowling alley, that is something that they would ponder and consider, and that is a source of economic growth and expansion that probably wouldn't have been a priority before the virus. And that's just one small example.
Right. That's I really enjoy kind of the positive kind of nature of understanding we do come out of this. And I think so often people are reading the media and everyone's becoming kind of a couch-based doctor and or economist. But I was going to end with what the outlook for real assets was, and I think largely you covered that. I think right now, if the tips in and around, maybe leave me and my clients with how you guys are prepared. What is the kind of the mantra to your investment team and yourselves? No hero moves, don't have to hit it out of the park here. How do we look to gauge your successes through this next phase? And, how do we view that cadence of how you will get more aggressive and where the fund is positioned today?
Sure. So one of the great advantages of having been a lead portfolio manager during 2008, 2009 is I have pretty much a roadmap and a template for what the exit for this looks like and what will be punished and what will be rewarded. And I can tell you with a great deal of confidence that going forward, what will be rewarded is transparency, visibility, and growth. We are going to be in a low growth environment for an extended period of time. And in fact, we were prior to this. And so so it's simple economics. wherever demand exceeds supply, prices go up. And in this environment, people are looking for growth, transparency, stability, consistency, and they're willing to pay a premium for that. And so when you look at real assets like real estate and infrastructure, where you have contractual revenues, you can gauge the quality of the counterparty to ensure that those cash flows will actually materialize. You're trading at discounted multiples, and where you have a history of tax efficient cash flow being generated by these businesses and paid out to investors as part of their total return. Those are two sectors that investors are going to gravitate to in the economic environment we're going to find ourselves in going forward. So we're excited about the returns that we're going to be able to generate for investors. And we think these are two sectors that investors should increase their allocation to going forward.
Awesome. Dennis, with that, I just want to thank you on behalf of myself and my clients and my team. Appreciate you having your hands on the wheel, and we'll be chatting soon.
Thanks again, Chad. Stay healthy.
Cheers. Thank you. Now I got to figure out how to turn this thing off.
I think you had it off there.